2023's banking crisis might not be over. You don't need to take our word for it. Let's hear from the head of America's biggest bank, who thinks the current crisis is not yet over, and even when it is behind us, there will be repercussions from it for years to come. But here's the problem. On the one hand, some people think this.
Oh, there are definitely more bank failures to come.
But others say it's not a crisis at all.
It doesn't walk like a banking crisis, it doesn't smell like a banking crisis, it doesn't even basically quack like a banking crisis.
In our last film, we showed you what can cause a banking crisis. But now, we want to know if the banking crisis of 2023 has finished. And if it hasn't, how bad could it get? The start of 2023 was pretty calm, all things considered. There was no global pandemic, no fresh war launched by a nuclear superpower. So what happened to the banking sector? Well, on the 10th of March, Silicon Valley Bank, or SVB, collapsed. With assets of $209 billion, SVB had been the tech sector's bank of choice. It received big deposits from companies with big pockets. But when it announced almost $2 billion of losses, and it needed another $2 billion to handle withdrawals, the credit rating agency Moody's downgraded the bank's bond rating. And that was a problem, because SVB had invested heavily in long-dated US bonds.
The United States is today, as it has always been, the best investment in the world.
Well, one of the biggest problems, and you could see that in the Silicon Valley Bank, is that when interest rates are raised, especially raised a lot in a relatively short period of time, which is what we've seen over the last year from the Federal Reserve here in the United States, the rising interest rate depresses the value of outstanding bonds.
SVB's stock price crashed 60% in a day, and US regulators sat back and watched.
All the depositors of Silicon Valley Bank just took their money out. A lot of banks that were interested in acquiring Silicon Valley Bank, but apparently the Biden administration decided they didn't want to sell Silicon Valley Bank to a big bank, okay? Because in Washington, there is this distaste for big Wall Street banks, and they don't want to get big banks even bigger.
The threat of contagion had begun. 2 days later, on March 12th, Signature Bank failed with assets of over $110 billion. To understand why, we need to tell you a bit about the snappily titled Federal Deposit Insurance Corporation, or the FDIC. If you have money in an FDIC-insured bank and it goes bust, they'll give the first $250,000 back. If you've invested more than $250,000, you're out of luck. But the FDIC was so worried about Signature Bank, they promised to insure all deposits.
But this time, the government has acted immediately to stem the losses using money from this institution.
We just learned in the last few hours that the federal government is taking steps to assure depositors will get their money, and at the time, ensure public confidence.
And it still wasn't enough. Spooked depositors headed for the exit, pulling out 20% of their money in a matter of hours. 2 days later, regulators pulled down the shutters. The FDIC blamed the bank's poor management and the pursuit of rapid, unrestrained growth. President Biden tried to ward off a crisis by saying this.
Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe.
But investors had other ideas. When First Republic was seized by regulators with assets of $229 billion, it became the second largest bank failure in history. That's 3 banks worth assets of almost $550 billion. Now, before we continue, a reminder that here at Capital.com, we make explainer videos about trading and economics, giving you insights on the market so you can make informed trading decisions. We're also a trading platform, so you can make your trades right on our website or using our app. After this, check out our film that asks if you can spot a banking crisis. Now, back to what went wrong in 2023. The collapse of First Republic was so dramatic, it's worth taking a closer look at their stock price. Between March 8th and March 20th, First Republic's stock price dropped almost 90% from $115 to $12 following the collapse of Silvergate, SVB and Signature Bank. On April 24th, the bank announced it had lost over $100 billion of customer deposits. 24 hours later, their stock price fell 50%. And another 30% a day later to just $5 from $170 back in August 2022. By May 1st, it had been taken over by the FDIC and sold to JP Morgan. If you take the assets of JP Morgan and add it to First Republic, you're left with a very big bank indeed.
But we've just taken a very large bank, First Republic Bank, and given it over to what was already too big to fail, thereby making it whatever the too big to fail designation might be. This is not a solution. This is literally taking a problem and solving it in quotation marks by making another problem in the banking sector even worse.
Over $500 billion lost by just 3 banks is an eye-watering sum. But does it add up to a full-blown crisis? If you want to know how 2023 compares with the financial crash of 2008, or you have questions about what might happen next, watch our final film on the banking collapse. Thanks for watching. You can read all our original market analysis by visiting Capital.com. There's a link in the top right corner and also in the description. And of course, don't forget to click on the subscribe button to stay alerted to more films on similar topics in the future.